Money market funds are the most popular investment in Kenya, but many people have several contentions about money market funds. Some people think that maybe money market funds should only be a reserve for the rich people. Other people think that you have to invest a lot of money in a money market fund for the investment in a money market fund to make sense, while other people think that a money market fund is the best financial product invested for the average Kenyan investor. So in this video, I'm going to be talking you through what money market funds are, what the advantages of money market funds, and everything that you need to know about money market funds. So let's get right into it. Let's start our discussion by understanding what is a money market fund. So a money market fund is a type of a mutual fund that invests in low-risk, short-term money market instruments. So out of that definition, I want us to break down that definition. So the first thing that I said is a money market fund is a type of a mutual fund. So what a mutual fund means is it's a fund whereby people pool their resources together or their money together, and then they bring this money under one pool for it to be invested together. So that's in a money market fund is done by what we call a fund manager. So in a money market fund, you have 3 or maybe 4 major market players who form the infrastructure of a money market fund. So you have the fund manager, whose role is to invest the money that has been pooled together by investors in this fund. Then you have the custodian, whose role is to maybe collect the funds that have been raised by these investors. So whenever you're investing in a money market fund, the money that you have invested is not held by your fund manager, but is actually held by a custodian, who is in most cases a bank. Then number 3, you have the trustee, whereby the role of the trustee is to oversee or maybe to supervise the roles of the fund manager. Remember, the fund manager has regulations that he has to follow that are stipulated by the Capital Markets Authority on each and every investment that he offers, whether it's a money market fund, maybe for this case. So the trustee oversees and makes sure that maybe the fund manager actually complies with the rules and the regulations stipulated by Capital Markets Authority concerning how a money market fund should be run. Then after that, we have the Capital Markets Authority, whose main role is to protect investors who are actually investing in any collective investment scheme or maybe in any kind of mutual fund that is regulated in Kenya. I mentioned that a money market fund is a type of a mutual fund that invests in low-risk, short-term money market instruments. So the other thing is the understanding of the low-risk, short-term money market instruments that money market funds invest in. So in other words, we call this the underlying assets. So for you to understand where a money market fund gets its return from, you have to understand its underlying assets. So the underlying assets are low risk. Low risk means that you can hardly lose your money in a money market fund because they invest in low risk asset classes. These low risk asset classes include treasury bills from the government. We have what we call fixed deposits from banks, call deposits, demand deposits, and also commercial paper from companies that issue commercial paper. Some of you may be asking yourselves, why maybe does a money market fund maybe invest in fixed deposits while I can also maybe invest in fixed deposits? Why do maybe money market funds invest in T-bills, so maybe I can invest in T-bills? Why do I have to invest maybe through a money market fund while I can maybe go for these options as my own? So there are a couple of reasons. Number one being that money market funds have a lot of money because they are actually pulling money from different investors. So if they go to a bank to maybe request for a fixed deposit or a call deposit or a demand deposit to the bank, they can actually be able to get a higher rate than maybe what myself, maybe what yourself can get, because they have way more money than the average person. And remember, fixed deposits have higher rates for the higher money that you have that you're fixing with a certain bank. Then number 2, for T-bills as well, they can also be able to bid in competitively. That means they can maybe be able to maybe get a higher rate or maybe a higher average rate than maybe what the average investor can get who bids in competitively, whether for a T-bill or for a T-bond as well. They also have access to opportunities that may be only available for institutional investors, like investing in commercial paper. So that's what maybe makes a money market fund maybe register a higher return than maybe what you will be able to invest directly as an investor. So from a definition of a money market fund, I mentioned that maybe a money market fund is a type of a mutual fund that invests in low risk, short-term money market instruments. So we have been able to understand what a mutual fund is. We have looked at the low risk, short-term instruments because we have looked at the underlying assets that these money market funds invest in. So actually it's stipulated by CMA, maybe the Capital Markets Authority of Kenya, that money market funds, or maybe that fund managers should only invest funds with a maturity of not more than 18 months for the money market fund. So that means they're actually very short-term instruments, so they can't invest in long-term T-bonds for the money market fund options. So now, after understanding what a money market fund is, you have looked at maybe the players that form the money market fund. So now I want us to understand maybe the structure of a money market fund. So for the structure of the money market fund, remember I mentioned that maybe the fund manager takes your money and invest in the underlying assets like T-bills, T-bonds, the fixed deposits, the call deposits, and the demand deposits, and maybe some commercial paper. So how do they actually get a return? So let's say at the end of the day, the money market fund has registered a return of 15%, and that's the gross return. Your money will be subjected to a 2% management fee. So these fund managers do charge a management fee, and that depends with from one manager to another, but the average in the industry is around 2%. So after they have registered the net return, they're going to charge you a 2% management fee. So from the 15%, now we deduct the 2%, we're left with 13%. So after you're left with 13%, then remember there's the withholding tax of 15% on your savings, or maybe on the interest that you have earned on your money. So now they also have to deduct the withholding tax of 15% from the 13% that remains. So if you do 0.85 of 13%, you actually get the net return to be 11.05%. So that's how the return is distributed in a money market fund. But then remember again, most money market funds, whenever they're reporting their rates, maybe in their dailies, maybe whatever you see on their social media platforms, they actually report or maybe post their returns gross of the withholding tax, but net of management fees. That means they have already deducted their management fee. What you only have to deduct is the withholding tax. So now let's look at maybe the advantages of money market funds. So money market funds have several advantages, because for me, I usually try to define maybe a money market fund in simple terms, that maybe a money market fund is just an upgraded savings account, because it gives you maybe an interest on your savings, and it also gives you the ease of access to your money. So number one is that it is very liquid, in that you can easily access your savings. So once you deposit your money in a money market fund, you can actually easily access your money within maybe a day or 2 days or maybe 3 days of asking. So yes, the money is not immediately accessible like you have it in your bank account, but some money market funds have that feature whereby you can instantly access your savings anytime that you want. But for most money market funds, you're going to be getting your interest or maybe your money from your money market fund maybe after 1, 2 or maybe 3 days of asking. That's when you'll get your money deposited in your bank account. Then number two, your money actually gets a very decent interest. So rather than saving your money in a bank savings account where your money is not getting any interest, or maybe your money is getting a very small amount of interest, you can actually now save your savings in a money market fund whereby your money is growing at a decent interest rate that beats the inflation rate. Remember, we save our money in avenues whereby we should actually be getting a return higher than the inflation rate, so that you can be able to maintain the purchasing power of our money, or maybe to beat the inflation rate. So that's the second advantage of a money market fund. The other advantage of money market funds is that money market funds are relatively safe, because you can hardly lose your money in a money market fund because they invest in very low risk asset classes. Actually, you can only lose your money in a money market fund if the money market fund is mismanaged. Then number four, the other advantage of a money market fund is that your money in a money market fund actually receives what you call compound interest. So your savings in a money market fund actually go through what we call monthly compounding. And we all know that compound interest is the 8th wonder of the world. That means that your money is continuously compounding month on month. That means the interest that your money will have accrued in a certain particular month is added to the principal, and then that money continuously compounds. It's a very good tool to compound your savings, even though money market funds are primarily used for short-term capital preservation. Then maybe the other advantage of money market funds is that your savings will actually be growing at maybe at a rate that equals the prevailing interest rates environment, maybe the prevailing inflation rate. That means you'll always be able to maintain the purchasing power of your money, and you're not going to lose your purchasing power to inflation. Those are the major advantages of money market funds. But then again, like we all know, we have the advantages and disadvantages of everything. So now, what are the disadvantages of money market funds? So the main disadvantage of a money market fund is that maybe it's not suited for long-term investing. Why I say that maybe a money market fund is not suitable for long-term investing is because you have a very limited upside potential in a money market fund, because remember, money market funds only track the inflation rates and maybe the prevailing interest rates. So you can hardly get a money market fund registering as high maybe as 20%, giving you a return of more than 20%. Actually, for most money market funds, when the interest rates are low and when inflation is low, you're going to get your money market fund giving you an average of 7 to 10%. But then when maybe interest rates are high, like maybe last year, you can get money market funds giving you maybe as high as maybe 15 or even 18%. But then maybe getting a money market fund giving you more than 20% or even more than 18%, actually even more than 15%, sometimes is actually very hard. So that's why I say that maybe money market funds are not good for the long-term investing, because you have other opportunities. Maybe you have better opportunities for making money and compounding your money in asset classes that can give maybe better returns, like maybe the stock market, like maybe in Bitcoin, and maybe other high risk assets than maybe what a money market can give you. Then number 2, the other disadvantage about money market funds, this acts as a double-edged sword in that you have the ability to easily access your money. So the people who maybe make their money market fund as their main savings avenue, you will find them that maybe they are depositing money in the money market fund. So you keep investing, then after some time withdraw. So you may find yourself that maybe in 10 years, you have actually been saving and withdrawing your money. So actually after 10 years, you have no savings on yourself because you have been saving and withdrawing your money because you have ease of access to your money. That's why it's very good to maybe use your money market fund just as a place for short-term preservation of capital, but not as a place for long-term investment because of those features that maybe make a money market fund not a very good investment tool for long-term capital growth. Moving on, investors love money market funds because they have very simple use cases, or maybe they have very good use cases whereby you can use your money market fund for several reasons. So number 1 is that most investors use their money market funds as their emergency fund. So remember, an emergency fund is a set amount of money that can help you, maybe that can act as a fallback plan in case you lost your job, or maybe in case you are going through a career transition. So you have some savings that can help you maybe proceed with your life normally, maybe in a period where you're not getting paid, or maybe you're not receiving your income. So most people use their money market funds to stack up the emergency fund. Then number 2, most people use their money market funds to stack up their sinking fund. So think of a sinking fund as a fund whereby you are saving for the known future upcoming expenses. So for example, you're planning to go on holiday this December, or maybe next year, you can save up for your holiday in a money market fund. You're planning to have a wedding sometimes later in the year, you can save for your wedding in a money market fund. You're planning to pay school fees next year, you can save for that in your money market fund. You're planning to maybe buy a car, you're planning to pay your insurance premiums, you can do all these savings in your money market fund because of the good qualities, maybe the good features of a money market fund. So those are the major use cases of a money market fund. Like I mentioned, it's a place for you to park money as you think about what you're going to do with your money. Then maybe the third use case of a money market fund is people use it to maybe save up for bigger investments. So for example, let's say you want to invest in real estate and you want to save up money and maybe not take a loan. You can save up money to get your exposure into real estate. You can save up money to maybe enter into the stock market. You can save up money maybe to enter into maybe a treasury bond or an infrastructure bond. You can use your money market fund to save up money to enter into big investments. Remember, we have two types of money market funds. We have the Kenyan shilling money market funds and we have the USD money market funds. So what are USD money market funds and who are they ideal for? So remember, the main difference between a USD money market fund and a Kenyan shilling money market fund is that a USD money market fund holds its assets, or it's based in the US dollar. So it invests in the underlying assets that are denominated in USD. So this being fixed deposits, USD call deposits, demand deposits, and maybe USD issued commercial paper. And some fund managers also invest some of this money in Euro bonds. That's how a USD money market fund differs from a Kenyan shilling money market fund. Its major difference is in the underlying assets. Then there are people who argue that maybe a USD money market fund has a lower return, because if you look at the returns, you'll find that most USD money market funds are returning between 4 to 7%. Most Kenyan shilling money market funds are maybe returning between 10-12%, depending on the interest rate environment. But that doesn't necessarily mean that maybe a USD money market fund is returning lower than the Kenyan shilling money market fund. So you cannot compare a USD fund with a Kenyan shilling fund. You have to base the two funds in the same currency. So the best way to know whether a USD money market fund is worth for you is to compare the USD return from the USD money market fund with other returns, or maybe with other asset classes that try to maybe compete with the USD money market fund. So these are other short-term avenues whereby you can use to save your money in USD. So these you can compare USD money market fund with the USD fixed deposit, the USD savings account, and maybe the USD high yield savings account, and with other such kinds of accounts. But then you cannot directly compare the return from a Kenyan shilling money market fund to a USD money market fund because of the difference in currencies. And then remember, we have currency movement. So maybe if you have two investors who have invested maybe in a Kenyan shilling money market fund and USD money market fund, at the end of the year, we also have to account for the currency movements. So sometimes maybe the Kenyan shilling is gaining against the USD, maybe sometimes the USD is gaining against the Kenyan shilling. So like I mentioned, the best way to evaluate the performance of a USD money market fund is to compare with other USD-based short-term investments, like maybe US treasuries, USD fixed deposits, USD savings account, and USD high yield savings account, but not with Kenyan shilling money market funds. Then who is the most suited person to invest in a USD money market fund? So for me, I usually say that if you don't earn or maybe trade in USD, then a USD money market fund is not for you, because like I mentioned, money market funds primary role is to short-term preservation of capital, or maybe a place whereby you can put put your short-term savings as you think about how you're going to do with your money, or maybe as you prepare, or maybe as you accumulate more savings to actually use that money for something else. There are people who ask me, if I invested a certain amount of money in a money market fund for maybe 1 year, 2 years, what's the expected return? There are people who also ask me, if maybe I continuously deposit, let's say 10,000 per month for the next 12 months, what is the expected rate of return? So I'm going to attach the link to this calculator that you can see on my screen here, whereby you can just play with the numbers here. You can play with maybe your initial contribution, you can play with your monthly contribution. If you want to maybe adjust for the number of months, if maybe you want to invest for 6 months, you can use the number of years as 0.5. If you want to maybe use 3 months, you can use the number of years as 0.25 years. So if you want to maybe change your calculation from years to months, you can maybe use the number of months as a decimal point, or maybe as a fraction in the calculator here. But essentially, you can use this calculator to actually play around with the returns. And the good thing with this calculator is that you can also maybe download the Excel sheet. As you can see from this button here, you can actually download an Excel sheet that shows you how your money is actually growing over time from this money market fund. Then the last thing about money market funds, the people who ask me about money market fund recommendations, maybe which is the best money market fund for me to invest with. So for me, I usually recommend the biggest two fund managers in Kenya, that being CIC and Sanlam money market funds. So I'm going to attach the links to those two money market funds in this video below, so that maybe you can open an account today with either Sanlam or CIC and start saving with your money market fund and start achieving your savings goals. Then as well, the people who asking, is it okay to have more than one money market fund account? Yes, you can have more than one money market fund account to maybe help you realize your different goals. You can use your one money market fund as your emergency fund, the other one as a seeking fund, and maybe another one as your investments account, whereby you raise money to actually investments portfolio. So that's it on money market funds. If you like educational videos and content about money matters and personal finance and investments, do consider subscribing to my channel, as I'll be releasing more videos that can help you make even more informed decisions. So that's it on this video. See you on the next one.